Welcome back to FUELSCast for a very special bonus episode. In this exclusive release, we're bringing you content from the 2024 D1 Expo held on August 27th in Nashville, Tennessee. Today's episode features an insightful segment from Andy Milton, Senior Vice President of Supply and Distribution at Mansfield, as he shares his perspective on the downstream oil outlook. Slides and graphs from today's talk are linked in our episode description below. We hope you enjoy.
Without further ado, I'm going to introduce Senior Vice President of Supply at Mansfield, Andy Milton.
Morning, and thank you, Zach. If those were here in Denver at the D1 2 years ago, very different situation. In 2022, it was really all about where is the supply. Supply issues were really kind of all over the place. We had Russia just invaded Ukraine. That created all kinds of challenges in the marketplace. Diesel futures had $1 backwardation, which was incredible volatility at that same time. I also had the lucky aspect of just going to talk about the Inflation Reduction Act days before. That gave me great content for that particular session. Now, I'm linking this, but I'm not trying to make a political statement here, but we also had historic inflation the last couple of years. So don't make that a political thing, but we will get into some political challenging questions here and statements. We also talked about sustainability was here to stay. And I know Jessica and Sarah, I think I saw you guys earlier, you're going to talk about that next. I love to talk about that some more as well with you. And then less biodiesel production in the marketplace and more renewable diesel production in the marketplace. Those are all the really hot buttons we talked about last time. And I would say many of that came to fruition, particularly less biodiesel, more renewable diesel, right? All right, so we get into this year. What's the big question? It's really a game of demand. So 2022 about supply, but now we're talking about what is the demand situation in the US, and we're gonna hit a couple different subjects here today. All right, you can't talk about the US and not talk about crude production here domestically. It has been fantastic for our economy. It's been fantastic for this country. As you can see, prior to COVID, we had a high of, it was right over 13 million barrels per day. We hit that high again in November, December of 23, and we're staying consistently above that range. That's a great thing for this country, a great thing for the economy, and a great thing for our energy prices. One thing to note, though, that I think puts that in perspective, Saudi Arabia just announced earlier this year that they've suspended plans to increase their production to 13 million barrels per day. Instead, they're gonna cap themselves at 12 million barrels per day right now, investment-wise. They have capacity to go 2 more million barrels. So they're at 10 today, can go to 12, are not gonna go to 13. I think it's a pretty interesting thing when you think about global supply and demand and who's gonna be running the show going forward. All right, I can't not talk about SPRs. I get a lot of questions about this from customers and folks, and certainly posted on my LinkedIn profile. But SPRs have been obviously drained quite largely the last few years. And that was really to help with the economy, help lower prices. Whether you agree with it or not, it did do that. Now, the one thing that I think people don't realize and appreciate, it probably didn't make fans with OPEC. Because not only did we lower prices globally, then we went back and asked them to produce more to keep prices lower, which is not what they want to do. So not a big fan there, I think, from the OPEC standpoint, or certainly from Saudi Arabia's standpoint. One thing I do want to call out, and you'll hear me say this theme a little bit throughout this session, I'm not hearing enough on the news about OPEC's reaction to stuff going on here and stuff going on globally when it comes to global supply and demand. So if those who recall, after the election in 2016, literally 1 week later, OPEC changed their strategy, okay? They changed their strategy to basically produce more to try to curb US production. In fact, actually, I'll go back 2 slides and you'll see that. See that slide, that little dip there in 2016? That was after OPEC basically said, okay, US producers, we're gonna try to squelch what you have going on over there. And to a degree they did, but you can see the US production climbed right back. So don't think that OPEC has forgotten that. In fact, actually Goldman Sachs this morning came out with a report saying they predict that OPEC may change their strategy as well, depending on who wins the election. So keep an eye on that. All right, can't talk about OPEC and not talk about quotas as well, okay? As you can see here on the chart, you've got quotas for all the different countries that make up the OPEC Plus group. Note a couple countries are not listed. Libya and Iran are not listed here, okay? Both of those have exemptions. But you do see, for the most part, adherence. Obviously, Saudi Arabia being the really big one you want to be watching from a quota standpoint. All right, U.S. Production. I get this question a lot. I don't know, no one knows for sure how big the U.S. production can go. We just talked about the materiality of it. Certainly, this is a good forecast, highlighting the fact that we might get very close to that 14 million barrel per day mark. But at this point, no one's predicting more production. So again, so for context, right? OPEC already started saying they're going to cap at 12. They're currently at 10. U.S. is producing at 13. Maybe we get to 14, and that's it. So from a standpoint of global crude production, depending on what happens with demand, there might be some constraints there that might have higher prices going forward. And then one thing also to keep in mind, right before the election in October, OPEC is set to make an announcement of what they're going to do. Currently, they're expected to increase production as they've had cuts lately, but I think that's a gigantic question mark for us all. And just like you saw literally yesterday, the fact that Libya's surprise government came down and said, hey, actually we're going to stop production right now, that 1 million barrels per day had the market go up quite considerably just yesterday alone. All right, and like I talked about earlier, I know I debated about my friends, my family, everyone thinks energy prices are high. I think they're actually quite cheap. Inflation-adjusted crude prices right here, okay? So we're right here, this is like the upper 70s, maybe at the 80 mark, and I think we're down a little bit lower today. You've still got basically cheap energy in the US, right? Natural gas is under $2, I think, right now. Crude in the upper 70s, mid 70s, when you're talking about Brent or WTI, that's relatively cheap, all things considered. So the US is very lucky to have that. Certainly helps with inflation. It helps all of our energy spend. All right, probably my favorite slide. All right, I got a lot of debates last night. Loved the discussion last night at dinner and during drinks. I tried to find something on demand, and kudos to the marketing team. They did a great job finding these slides. But this I felt was the best view of forecast demand out there. If you can't see in the back of the room, if you're unable to see it, the very top bar, that top dotted line is OPEC. No big surprise, they would be bullish the marketplace, right? They want to be bullish. They almost desire it to be at some point. They're gonna help try to keep prices high, but not too high. At the very bottom, IEA, International Energy Agency, probably a little bit low, I would say, demand-wise. I would say they're heavily slanted on the sustainability, green energy initiatives, renewable fuels, which I love renewable fuels. I don't see IEA's forecast come into fruition by any means at all. I would say a very good maybe viewpoint would be look at the red line with ExxonMobil, the yellow line with Shell, and the green line with BP. That's kind of that center of the mass. You've got to basically peak it a little bit the next decade or two, and then maybe fossil fuels starts to get that gradual decline as we enter 2050. We got some heavy debates on that last night. That was fascinating and fun. A couple things that I want to call out when it comes to that, though, is it's so many variables, right? You got so many technologies that are going to come out. I certainly am not expert on AI, but I can expect that's going to have some advancements in the next few decades that we can't even imagine. So it is quite possible we'll see fuel demand, certainly fossil fuel demand, potentially peak out at some point in the next decade or two. And that's a tough topic. Hopefully we'll get some good questions on that today. All right, can't talk about global oil field demand and not talk about two countries. There's really two countries that matter. It's the US and it's China, okay? And obviously we're gonna talk about the US here in a little bit, and we're all certainly feeling some certain situations going on there, but beyond those two countries, it's a massive drop-off in fuel demand. Now I would expect India to increase the next few years, next few decades as well. Africa, Middle East, areas where population is increasing, yeah, fuel demand will certainly increase. Chevron just announced a $1 billion investment in India alone. So they're certainly seeing the potential increase in India. But, here's always a but, right? China. China's a concern. Certainly you can see here, we've got coal, oil, natural gas, renewables, all growing. But there's been such a growth rate the last few decades, now it's coming to be a problem. And just recently, I think it was last week, actually Michael Sr. sent this note to me because he had seen it on the news. China's diesel demand was down 11% year over year. Now granted, they've been growing like crazy. Infrastructure, bridges, roads, and that's great, but at some point that starts to slow down, and that starts to have an impact on the marketplace. For those that recall, just a couple years ago, coming out of COVID, Every bank and trading company said prices are going to go crazy high. Post-COVID, China's demand is going to come roaring back. It's going to be amazing. High prices, high prices, high prices. And it really didn't actually happen. And I think, again, part of that is due to the fact that the population change was so massive. All right, some people would be too young to remember this. Some people older certainly remember this. In 1980, China's one baby policy. All right, they might have had some reasons for it, but you could see that actually comes down and causes a massive problem. Look at 1980, and then ever since then, what's happened with the population in China. In fact, it's actually the last 2 years, negative population impact. And now I think it's 2 million people in that last year alone. So what does that do to fuel demand, right? All right, let's get into U.S. demand, and particularly we're gonna talk about diesel demand here specifically. You can see the trend is actually slightly lower. This is from the EIA, all right? Again, diesel demand year over year is definitely down here in the U.S. And it is economically driven, by the way, no pun intended. Bankruptcies are up right now. Consumer concerns on credit card default, delinquencies. I'm not gonna get into the U.S. deficit and the U.S. debt. We all are gonna just get sick on that one. But let's call out the U.S. unemployment rate. That revision that came out last week of 800,000 jobs lower is a big deal, okay? The one positive that had kept us all going was the job employment situation. And granted, to a certain degree, that's what the Fed has been doing, trying to slow things down a little bit, but maybe that soft landing might be a little bit tough. We'll see, no one knows for sure. I'm not trying to be a predictor here by any means, but I get freaked out when I see revisions of that magnitude. That certainly is concerning. All right, diesel supply, one of my more favorite topics right here. All right, so we got a lot of numbers here for you. Let's roll through it a little bit. So again, 2022, really difficult supply period. We were coming off a time period we had less refineries in the marketplace. We had the demand roaring back post-COVID. So inventories have improved a little bit. You can see diesel demand on that top right is down quite a bit. But I want to call out the new record high of diesel exports that just came out just last week. So stronger dollar, relatively speaking, cheap energy prices, and slower demand. We've got to get that product out. And so if you're a Gulf Coast refinery or you're on the East Coast or you have access to other markets, you're going to do what makes sense. You're going to get that product to whoever's willing to pay the most. And a lot of that has been going to South America. Another thing that impacts us, if everyone's in the middle of the country, maybe the Group 3 Chicago markets, you're seeing this volatility when it comes to price volatility. So think about fuel prices for a second. Futures market, that next layer is that regional basis level. So here's ULSD basis values. We've got Chicago, Group 3, which is basically the Midwest, and Gulf Coast for context. See that big line where it goes $1 a gallon last fall? That actually happened. And it happened right in the Midwest, and it was basically a situation where there was not enough supply to meet the quick demand that was popping in the marketplace. And then not just a few months later, it was 60 cents under the NYMEX. So a $1.60 move in the specific region of the country in just a few months. Pretty phenomenal volatility, and I think that volatility is going to be here to stay, particularly these landlocked refineries zones where they don't have access to exports. All right, let's get into gasoline for a second. This is, again, we got into some great debates last night. I really enjoyed that. Think about gasoline for right now. If everyone thinks about last, I think it was 2022, when I mentioned it, I think we peaked in gasoline demand. The last high of gasoline demand in 2022, that might be it. We'll have to kind of see how it happens. We'll have to see what happens with population, with the economy, with drivers and other adoption of EVs and hybrids. But right now, 2019 is the peak of gasoline demand. Even after the COVID recovery, we haven't gotten back to those numbers. And I think that's a really big deal. Let me go back on 1 second on diesel. I want to call out one thing. Only because I talk about it all the time. So you hear me talk about days of supply of diesel. One thing I want to call out here is it's got inventories and you've got demand. The balance of those two, and this is back in 22, 23 when Fox News made it famous. I'll blame someone else, it wasn't me. It wasn't me that caused Fox News to put that on TV. But 25 days of supply, what we had, that caused all those massive price spikes and challenges in supply. We've been steady for 6 weeks in a row now at 34 days. So we've gained a large amount of diesel And it's not really supply driven, it's mostly demand driven. Just wanna make sure I called that out. All right, let's get back to the refining and the supply side for a second. So again, as a supply guy in general, this is stuff that kind of worries me. For context, you go back to the 80s, you had 300 refineries in the US. We're now running 132. We got down as low as maybe 126, 128 post-COVID. Well, do you think that occurred because people just wanted to make more? No, it was because the margin said, go crank up every distillation unit you could possibly have, bring more supply to the marketplace. And for those that don't know, the 3-2-1 crack spread, 3 parts crude, 2 parts diesel, 2 parts gasoline, 1 part diesel, is basically just a good indicator of the refiner's margin. Well, when you have 3x normal margin, you're gonna find a way to make more product. But look what's happened in the last few months, and this year particularly. It's lowered a lot. And so, I'm a supply guy, I worry, is that increase to the 132 gonna start decreasing again? Because there are already people today, refineries today, that are not profitable at today's economics. If we get less demand, they're certainly not gonna be profitable. All right, let's get into what the capacity could be. So just like we hit, in my opinion, peak US gasoline demand in 2019, we may have peaked in US refining capacity as well. Remains to be seen. Again, demand, supply, the economy, we'll have to see what happens here. But just shy of 19 million barrels per day before COVID. We lost about 5 or 6% of that post-COVID with all the demand destruction. We've clawed some of that back. Again, the industry is phenomenal at finding opportunities, and if there's a margin to be had, like that crack spread of $40, they'll find it. Well, I don't know that we're ever gonna get back there. We did get ExxonMobil, Beaumont Refinery had an increase earlier this year of about 200 million barrels, 200,000 barrels per day. The Lyondell Houston facility, which has been kicking the can for years about closing, that's likely to close sometime in 25. That's gonna basically offset the Exxon increase. Those are gonna be situations we're gonna have to sit and watch. I will say though, utilization-wise, we're at a very healthy rate. You can see historically speaking, we get down to the Winter Storm Uri, the pandemic, hurricanes there in September has some declines. We're at a solid 90-92% right now. And there's nothing wrong with that. That's actually very, very healthy. Although, expect some declines coming up because we are entering planned seasonal fall downtime, particularly around the Chicago, Ohio area. Watch out, guys, you might see some challenges from a supply perspective. And then global capacity, which I think is really neat to see the changes globally happening, both from a demand standpoint, where the demand is, where the production is, and where crude is, where maybe technologies and advancements are coming, where people are maybe focusing on green fuels globally. A couple things I'd point out. You've got gasoline, less of an increase than diesel. What does that tell you globally? You've got refineries in Europe potentially closing. They're older, they're more costly to run. We talked about that cheap US energy. And then particularly the Dangote refinery in Africa, they're talking about it's a 650,000 barrel per day refinery, the largest single train unit in the world, if and when it operates. There's a lot of people though debating, will that facility actually operate on time and consistently? And they're already actually selling crude back in the market because they can't process it. They bought so much crude, they're not able to process it right now. But when that is operating, that's gonna put a lot of diesel in the marketplace. Right, forward curves, I get this question a lot. What are prices gonna be? In fact, actually, that might be a question we get in the Q&A. Heating oil is basically representing diesel futures. RBOB would be gasoline futures. Two things you would point out here is there's a little bit of a seasonal bump up. That's that contango we talk about. And then you're back down to backwardation on distillate. And then gasoline, you've got this demand curve and also product spec curve that happens between the summer and the winter period. Just because it's lower in the future does not mean that the market is saying it's gonna be lower between today and 2 years from now. That's not at all what it's saying. It's saying that the structure today could go up or down, but that's right now, it's basically saying bring that product to market. We're a little bit tighter now than we maybe anticipate going forward. No reason to store that product. But the big summary today that I want you to walk away with, I think volatility is here to stay. We talked about the Midwest, the basis volatility. I do think there's potential. We could see lower low prices on basically demand concerns, economically driven. I do think there's certainly the potential for higher prices. Certainly got global conflicts going around the world. Middle East is a constant hotbed of stuff going on. You've got U.S. refining capacity that, again, I think potentially has capped out. And really, think about OPEC and what their intentions are. They don't want to be second fiddle. And I think watching the U.S. marketplace, they're going to potentially change strategy depending on who wins the election. We'll have to kind of see how things play out.
We hope you enjoyed today's episode of FUELSCast. If so, be sure to subscribe and leave us a review. This helps support our podcast and ensures that you never miss any new episodes. If you have any questions or podcast topic recommendations, please reach out to fuelscast@mansfieldoil.com. Bigger reach, broader solutions, better advice. Now you can.